Today's letter comes to us from Little Victoria. Little Victoria writes, Dear George G., what is a basis point? Trying to understand what a basis point is, and it really doesn't make any sense to me. Well, Little Victoria, thank you for your thoughtful letter and for having the courage to say that you don't necessarily understand something. It doesn't necessarily make any sense, but you know that it's important, so you would like to better understand it. And Daniel Kahneman, rest in peace, famously said that a very, very, very damning statement. He said that the entire financial services industry is built on the illusion of skill. Whoo, buddy. And so, because he believed it was based on an illusion of skill, there's so much complexity that is sort of built up that dissuades regular people like you and I from engaging with it or from asking too many questions, from sort of peering behind the curtain to see what's really going on here. How much does this stuff cost? How much money are you making? So I'll get into a technical definition of what basis points are in just a second, but fundamentally it's used, basis points are used for a lot of reasons. But one thing that they're definitely used for is charging you and I four things. You can use basis points to charge you a fee, to manage your investments, to do planning for you. Basis points are used to represent the cost of an investment. So the S&P 500 mutual fund or exchange traded fund or ETF, it has a cost to it. It's not free, and that is represented in terms of basis points. So instead of a financial person telling a client, I'm going to charge you $20,000 a year to manage your portfolio, they'll say, well, we charge X number of basis points. Oh, okay, it's that many basis points. So it's just different. Is it nefarious? No. No, of course not. Is it an extra step in the chain of helping me figure out or slowing down, making it a little harder for me to figure out how much stuff costs? Maybe. But once you understand how it works and how to apply this unit of measurement, which is what basis points are, then you'll be able to figure out how much stuff costs. And that's fundamentally what I want you to take away from this, what I want you to be comfortable and confident doing and knowing is that this is how much this thing costs. So a basis point, or BP, it's a unit of measurement used to describe lots of things. You can use it to describe changes in interest rates or yields. We use it to describe changes in interest rates for loans, bonds, and other fixed income investments. They used to measure the difference between two different interest rates. Fundamentally, what I talked just about a minute ago is that a basis point is also used as a unit of measurement to tell the investor customer how much something costs. So I don't know that I did a very good job of explaining that part of it, but fundamentally basis points are this. You know how there are 100 pennies in a dollar? Yes, we understand that. So 50 pennies is 50 cents, so it's half a dollar. There are 100 basis points in a percent. Okay, so 1% equals 100 basis points. $1 equals 100 pennies. So that's how that works. So if something is 200 basis points, that's 2%. If it's 500 basis points, that's 5%. If it's 50 basis points, that is half a percent. If it is 1 basis point, that is 0.01%. If it's 10 basis points, that is 0.1%. Okay, so if it's 150 basis points, that is 150 basis points. 150 basis points equals 1.5%. See how I landed there, playing there? Okay, so that is how, when you're looking at the prospectus, which is the legal document of an investment, if you're on just the internet researching a mutual fund or an exchange traded fund or something like that, and it says that the expense ratio is 0.47%, that's 47 basis points. If it's 80% or 0.8%, that's 80 basis points that you are being charged for that investment. Okay, so now you know. And then you can obviously apply that to if you have a financial person that you're talking to and they say, well, we charge, 1%. Well, that's 100 basis points. That one's pretty easy. And if it's 1% on your portfolio, that means that however much money that they are managing, if they're managing $1 million for you, 1% of that is $10,000. Okay. Is that fair? I don't know. I have no idea. I don't know what it is that that person is doing for you. You are the person who needs to make that decision as to whether or not something is of value or if it's a fair price. So that is how that goes. I wanted to talk about this because we're on the heels of Vanguard announcing what they refer to as the largest fee cut in its history. So I'm assuming that that's true. And Vanguard is saying that the move, that this fee cut will save clients $350 million dollars this year alone. So that's pretty amazing. So talked about how fees on 87 of their different funds were reduced an average of 20%. Wow. So fees on 87 different funds were reduced on average 20%. Now that sounds like a lot. 20% is a lot. We're going to get into what that really means in just a second because numbers are a funny thing and you can present them in ways that make something seem very, very dramatic when maybe in fact it's not that dramatic at all, but over the long term and over enough dollars, obviously, it is making a difference because Vanguard's telling you it's going to save all of its clients $350 million dollars a year. So they've got a lot of clients. So how meaningful is a 20% reduction in these funds? We will talk about that in just a second. It goes on to say that after the cuts, Vanguard's active fixed income ETFs. So active fixed income ETFs. So that's exchange traded funds. There's all these different kinds of mutual funds and exchange traded funds. Active fixed income is one aspect or one segment rather of that. They're saying that in this one area that they will have an average expense ratio of, wow, 10 and a half basis points. Okay, so that's 0.105% compared to an industry average of 0.53% or 53 basis points. So we understand that now. So this decision, it's going to maybe put pressure on the other big money managers out there, like BlackRock and Fidelity, as well as smaller firms that may charge higher fees as customers seek more value. Put a pin in that right there. We're going to put a pin in that and circle back on it as customers seek more value. Well, we need to talk about what that means too. So, effective February 1st, the firm of 2025, the firm reduced fees on 168 share classes across 87 funds. So here's a whole nother thing too, is that not all mutual funds are the same. They have different classes. And I tell you what, I'm going to have to circle back on that one. We will do a separate episode on understanding different share classes because it's certainly a really, really important thing also. So, Vanguard founder John Bogle explained why investment costs matter this way. In investing, realize that you get what you don't pay for. So that means that any fees that you're paying are taking away money, your account value. So if you're paying high fees, it's shrinking the amount of money that you have invested working for you. All right. Nothing is free. We'll circle back on that too. We need to pay for things if we expect to get good management and a quality product. So don't expect things to be free. So anyway, back to Mr. Bogle. Whatever future returns the markets are generous enough to deliver, few investors will succeed in capturing 100% of those returns simply because of the high costs of investing, all those commissions, management fees, investment expenses, yes, even taxes. So pare them to the bone. Yes. Briefly on Vanguard. What an incredible company. Briefly on John Bogle. What an incredible human being who pioneered and brought passive index low-cost investing to the masses. He democratized the investment process and drove fees down dramatically. So we are all indebted to Mr. Bogle, and it should probably be a national holiday, certainly in the financial industry. So thanks to Mr. Bogle. But what are we really talking about here? What are we really talking about? What difference does all of this make? We talked about saving their customers $350 million dollars just in the first year. We talked about making cuts, 20% cuts to the cost of these investments. So I don't want to minimize this, but I just want you to understand what we're really talking about here. And I'll go through five different fixed income, which are bond investment options or funds, and then I'll go through five different stock funds. Okay. So every single one of these funds has an expense ratio, and that is what you are charged every year when you invest in these funds. Okay. And so for Vanguard, they've got something called the Total Bond Market Index Fund. Before these cuts went into effect, that fund charged you 5 basis points a year. So 0.05%. That's really inexpensive, amazingly inexpensive. Now, the new expense ratio after these massive cuts took place, you can do the math on this. It went from 5 basis points to 4 basis points. Okay, let's talk about another one. Vanguard's Treasury Money Market Fund. Before the cuts was at 9 basis points, so 0.09%. After, 0.07. Vanguard's Intermediate Term Corporate Bond Fund went from 4 basis points to 3. Vanguard's Short-Term Investment Grade Fund went from 10 basis points, 0.1%, to 9 basis points, so 0.09%. Vanguard's Tax-Exempt Bond Fund went from 5 basis points to 3. So, like I was talking about, across very, very large numbers, this makes a giant difference. And I'm going to break it down in just a second and use a real world example. But just to kind of round this out, on the stock funds, they had something called the FTSE Developed Markets ETF. It went from 6 basis points down to 3 basis points. So that went down 50%. The dividend appreciation ETF went from 6 to 5. Information technology ETF went from 10 basis points to 9. Their emerging markets went from 8 to 7, and their total international stock ETF went from 8 to 5. So some of those are dramatic, some less so. I'll let you be the judge of what you think. So let's think, and this is a fairly generous example, because what I'm going to do is just say if we had $100,000 invested, $100,000 invested over the course of 30 years, getting an 8% rate of return, how much would that be? Okay. So it would be $1,006,265.69. Okay. So 30 years, throw 100 grand into an account. You have $100,000 in an account. 30 years later, at 8% rate of return, it grows to over $1 million. $1,006,265. Okay. With the fund cost reduced by just 1 basis point, bringing the total return to 7.99%, the future value would be about $1,003,474. So this results in a difference of about $2,791 over 30 years. So that sort of minimizes it. I sort of crapped all over the big announcement here. And it's probably even more, of course, it's more so if we're just building that up along the way. I said I was being generous because I was starting with $100,000, and most people don't start with $100,000. We're saving, hundreds of dollars at a time. Our 401ks, we're throwing in, contributions every month. There's not that many people that have $100,000 sitting around, but just so you know. So I'm not poo-pooing this because Vanguard has done so many wonderful things for investors, truly. And it's just not quite as dramatic as maybe we would come to think. The work that they've already done their work. They've already made and driven down the cost of investing and made it available to so many people. So I really, as I'm going through and crapping on them, I'm feeling guilty about doing it. But more, this is just, I want you to understand how basis points work. And I want you to understand how basis points work. So you can look at your statements and evaluate how much am I paying? How much is this person making? How much is this company making? And is it is it going to get me where I want to go? Do I think that this is a good deal? So, said I wanted to put a pin in value, in the idea of what value is. So, value is, the famous saying goes, if cost is what you pay, value is what you get. Cost is what you pay, value is what you get. So, these days, and let's assume that this move causes State Street and whatever, Vanguard or BlackRock and Fidelity and all the other investment managers to follow suit. And so they reduce their charges by 20% also. Awesome. Is that value? I don't think that it is. That's the cost. And if every S&P 500 index fund becomes free, which we're just about there. I think that there are firms out there that you can buy a share of the S&P 500 and have no ongoing charge. So 0 basis point management fee, a 0 basis point asset charge. I think that that is the case. And if it's not, it will be soon. So is that of value because what makes something of value is scarcity. What makes my kids valuable is that they're my kids and there's only three of them. It's not that I don't like your kids, but mine are more valuable to me. The Mona Lisa is valuable because there's only one. You get the idea here. So scarcity makes things valuable. Scarce things are of value. So therefore, when the cost of something is zero, I don't know if that's valuable necessarily because it just is now. So we don't really place a real big premium on air because it's free, even though it's the most important thing that's out there. If there was less of it, well, we'd be a lot more excited. And we're kind of seeing that with water more and more these days. We're realizing just how valuable it is as we need more and more of it. So here's the thing that we know that there's no such thing as a free lunch. These financial companies have beautiful offices and beautiful buildings and lots of high-paid professionals and employees that are working for them, and they sponsor everything, and they are just ubiquitous and omnipresent. So is that good or bad? I don't know. You have to make the decisions about what is of value to you. What is the value of advice? What is the value of portfolio management or money management? What is the value of all of these things? We need to make a decision about that. A big part of that is understanding how much these things cost, because everything costs something. Going back to the whole big building thing, I mean, think about it like this also. You go to Las Vegas. What an extraordinary place. It's an absolute spectacle. They're obviously making money. So every time you go into Vegas and you take a couple $100 or $1,000 out of a casino, well, that is an uncommon thing because they are not in the business of losing money. And going back to the idea, the reality that there's all these big financial companies with all the money and they're buying up everything from single family homes to whatever. Who knows? Who knows? We need to make decisions on what we find to be of value. So no free lunches. You are paying for your money in some form or fashion. And what is critically important from my perspective is that you know just how much everything costs. And then when you know how much everything costs, you can make a decision on whether or not you believe it to be of value. So what does that mean? Well, let's just pretend that I am your financial advisor. Okay. How fun would that be? You would want to know how much money I was making being your financial advisor. So how am I making money? Am I charging you a fee? Okay, maybe I'm just doing that. Maybe I charge you a flat fee, $1,000 a year to to meet with you and give you financial advice, right? So I'm a financial planner. I'm charging you a fee for giving you advice. Okay, that's about as straightforward as it gets. But then am I making a fee for giving you investment advice on top of that? So there are something called managed accounts. So that just means that within my portfolio at Merrill Lynch or Wells Fargo or Charles Schwab, I'm working with a financial advisor, and I've got a portfolio of 20 different investments, combination of stocks, exchange traded funds, fixed income investments, bonds, stuff like that. So I've got this whole portfolio. Exciting for me. So we need to understand how much each one of those individual investments cost, because we just went through and talked about there's a cost for each one of those. It may be minimal, but there's still a cost to it. Some of them are way more expensive than what we just went through with Vanguard. But then there's also a program fee, a wrap fee, an overall account fee that can range from, probably 10 basis points to who knows, upwards of 100, maybe even higher. So these are fees that are coming out of your account that you are paying for and that are reducing the amount of money that is invested for your future and your goals. And then who else knows who else is getting paid what? So how do you know? You just have to ask. You could start by looking at your statements and start by looking at the prospectuses and stuff like that. But I would simply ask your financial advisor, how much does all of this cost? What are the total costs to me that I am paying? Either my investments are paying them or I'm paying you directly. I want to know what the total costs are to me. And hopefully they'll be really comfortable answering that question. So hopefully they're providing you with a ton of value and you pay that happily because that's a worthwhile exchange. Everybody's getting something out of the deal here. So how to bring this full circle. Um, all the respect in the world of Vanguard, all the respect in the world to Jack Bogle and the work that he has done to drive down the cost of investing and bring what I believe to be a great way to invest, which is passive index investing, to everyone, as many people who want it. Second is it's important for us to have a good understanding of basis points, and hopefully I've made that more clear, demystified it, made it really easy to understand for you. So now you can go and look at all the different costs that show up, but then also be confident in asking your financial advisor, what are the total costs to me that I'm paying or that are coming out of my account? And they should be comfortable answering that question. If they're not, I would say that that's a red flag. So, all right. Well, thanks, little Victoria, for the thoughtful letter. Hopefully, I was helpful there. And as you go forward into your life, you will be able to have more money working for you and less money going to fees and expenses. And then finally, a reminder that cost is what you pay, value is what you get. Just because something is cheap does not make it good or of value necessarily. Finally, friendly reminder, never going to be anybody more interested in your financial success than you are. So act accordingly.